The more positions you can have in your investment portfolio, the better off you'll be when taking advantage of tax loss harvesting. Maybe just having 2 or 3 index funds is a good position for you to be in just when you're starting out and only starting to save and build that capital for your future. But oftentimes, once you kind of break $250,000 in assets, it might make sense to have individual index positions inside of your portfolio. That way you can take advantage of tax loss harvesting. I think this is probably the number one mistake that most people don't know that they're making when managing their own portfolio. Tax loss harvesting is when you're strategic about selling certain positions or securities, recognizing that loss on your tax return, and ultimately offsetting some of your ordinary income. Now there's limits. You can only do up to $3,000 against your ordinary income, but for other investment income, you can offset it. For example, if I had $50,000 gain from my portfolio and I had some losses that represented $40,000, I could potentially use those losses to offset those gains, and I'd be left with a $10,000 net investment gain. That could be really strategic in timing when you sell certain assets, whether it's real estate, a business, or a position in your portfolio. Let me reiterate, if you're just starting out, it can make a lot of sense just to have 1 or 2 index funds, assuming you've got a lot of diversification and exposure to the market. But the complexity will eventually find you, and it can be really strategic to consider tax loss harvesting. A word of caution for you, this really only applies inside of a brokerage or taxable account, so not a qualified account. Qualified accounts would include things like an HSA, a Roth IRA, or your 401k. Those already have special tax shelters on them. One more word of caution for you. We want to be sure to avoid the wash sale rule from being triggered. That essentially means that if you sell an investment at a loss, turn around and buy a substantially similar investment within a period of time, typically 30 days before or 30 days after, then that loss cannot be used. You have to wait a period of time in order for you to actually absorb that loss and get the real tax benefit. I'm Rizek, CPA and certified financial planner. Follow me for more tips.